since April. Our next guest says there's potential for the S&P to decline even as the average stock in it goes higher. Joining us now, Jack Ablin, Chief Investment Officer at Cresset Capital. Jack, good to see you. This wouldn't be the first time that happened, right?
No. In fact, if we go back to 2000, 2001, that exactly happened. Now, I'm not suggesting that we're in an internet-type bubble here, but I will say, if you look at, for example, cap weight minus equal weight, cap weight has outperformed equal weight by more than 11 percentage points or so over the last 6 months. That's the widest spread since 2000. And so if we dial back to 2000, 2001, what happened? Fed started raising rates at that time. That took a lot of the air out of the internet stocks. The S&P actually declined around 20% in 2000, 2001, and yet the average stock increased 8% over that time frame. So what we're telling clients is, look, we don't get nervous if we see the S&P decline. It's not necessarily quote unquote bear market. The average stock, as we start moving down in market cap, could actually advance over that same time frame.
So Jack, how should investors play this, given that if you look at the Russell 2000, it's higher ostensibly because smaller stocks there are more likely to be carrying short-term debt, and as interest rates come down, that's less of a burden for them to have to pay more for that. But if we run into an overall slowdown in the economy that's more than some would hope for, small caps are also likely to get more hurt if things slow down. So are there certain sectors, certain industries that are also likely to get relief from lower rates where investors should be aware?
Yeah, I mean, so let's take, for example, the S&P equal weight. One of the things we're doing is similar to the equal weight. We're looking at quality. We're still focused on quality, but we're broadening our reach. So if you look, for example, at the large cap X Mag 7, its debt to EBITDA is around 4 times, whereas the Mag 7 debt to EBITDA is less than 1. As you mentioned, small cap Russell 2000, that debt to EBITDA is nearly 6. And so here's a great way to play, an easing environment. Plus, one of the other things, we do have some fundamental justification for what we'll say the average stock or the S&P X Mag 7, and that is earnings. Over the last 4 quarters, all earnings growth was fueled by Mag 7 growth. I mean, Mag 7 earnings were up over 50% for 3 consecutive quarters year over year. As we move into the next 4 quarters, that's converging. It's coming down to around 20%, and S&P X Mag 7 earnings growth is actually ramping up from negative to, call it 15% or so. On average over the next 4 quarters. So not only will we get the benefit of lower rates and, of course, easier financing conditions, but we should have some profit growth underpinnings of that valuation.